Thank you all for joining this fifth year webinar. My name is Adarsh Giri, Head of Capital Formation and part of the investment team at Fifth Era. And it's my pleasure to welcome you to the year-end 2025 edition of our biannual Meet the Blockchain Unicorns report, where we track the early stage value creation occurring as a result of blockchain technology. To be honest, this really couldn't be a more timely discussion. Over the past 6 months, we've seen the industry's largest acquisitions continue to accelerate, renewed IPO and public market activity, as well as sustained institutional engagement across digital assets. Volatility has remained a feature of the market, but as we go through this presentation, we'll discuss some of the drivers behind that. Before we dive in, Fifth Era, as a registered investment advisor and a fund manager, I do need to show you this disclaimer. Today's webinar is meant to be purely educational. Nothing mentioned here should be construed as investment advice, and you should always do your own research. If you're interested in learning more about our funds or about Fifth Era more broadly, please feel free to reach out to us directly at ir@fifthera.com. So just looking at Fifth Era at a glance, this slide gives a quick overview of who we are. At Fifth Era, we're a specialized asset manager providing access to exponential technologies that we believe are transforming the world. Essentially, we specialize in investment strategies which construct portfolios of hard-to-access funds and direct investments through our two investment strategies, which are AI Access and Blockchain Co-Investors. We're now SEC registered in the US and FCA appointed rep in the UK, and our funds are registered in Switzerland as well. We've been investing in frontier tech businesses for just over a decade now, and we manage 7 funds across all of our technology verticals. These together provide the exposure shown at the bottom of this slide right here. So as of today, we have capital deployed across more than 1,500 blockchain companies and projects around the world, and that includes more than 80 early stage companies and projects valued at over $1 billion, commonly referred to as unicorns, which is the focus of today's webinar. So our goal, which you can see here, is quite simple. We aim to provide our investors with global diversified exposure to the leading early stage venture investments, all delivered on an institutional platform. So as the market matures and outcomes concentrate, we believe this kind of diversified and persistent access becomes increasingly important. In terms of our investment thesis itself, we do an entire webinar on this topic, so I won't spend too long here today. But generally, this is the core investment thesis that our managing partners wrote down almost 12 years ago, and it's changed very little since. In short, just as communications and content went digital over the past 30 years, which unlocked enormous value, we believe that frontier technology, particularly blockchain, is now enabling the digitization of commerce and finance. Because businesses, individuals, and governments, they transact constantly. So we believe this will ultimately represent an even larger value creation event and a value unlock, if you will. So on this slide here, we've got the logos of more than 50 blockchain venture funds that we partner with to deliver on that value proposition. Many of these relationships span multiple years, and we've made numerous follow-on investments together across market cycles. This network is now a very key part of how we maintain this broad coverage and the consistent access that we can provide to leading opportunities globally. So before we get fully into the results here, I want to spend a brief moment on the methodology used so that everyone understands how to interpret the data that follows. To track early stage value creation resulting from blockchain technology, on our side, we maintain a comprehensive database that spans both private and public markets. On the private side, we track blockchain enterprises valued at over $1 billion. And these valuations are informed by our portfolio data, venture partner network, publicly disclosed funding rounds, and even some secondary market trading when it's available. On the public side, we also track crypto tokens trading with market caps above $1 billion. And these represent decentralized token-based value creation that is unique to blockchain, And in practice, that often reflects early stage network adoption more directly than just equity alone. Because we are also venture investors, we focus on exit pathways and liquidity. As a result, and throughout this analysis that we're going to go through today, we also go over the growing universe of public blockchain companies, spot Bitcoin ETFs, and public companies that hold Bitcoin as part of their treasury strategy. So when you put all of that together, this framework gives us a very comprehensive and almost a bird's eye view of how value is being created, how it's being scaled, and eventually how it's being realized across the blockchain ecosystem. So, stepping back at a higher level, the year-end picture, it reinforces a very clear message. The blockchain industry is continuing to mature structurally, even though there is some volatility persisting at the surface level. The total number of blockchain enterprise unicorns, it's remained broadly flat over this period. But what I would flag here is that it's important to remember this headline figure, it masks two offsetting dynamics. Mature companies that are exiting through acquisitions or public listings, alongside new companies that continue to reach unicorn scale. And that's via clear product market fit and institutional relevance. Across both private and public markets, we're seeing stronger alignment between capital deployment, regulatory clarity, and real-world adoption. So that's improved exit visibility, particularly in the case of mature infrastructure and financial services businesses. So these dynamics, they generally suggest a transition away from broad-based expansion and towards integration, scale, and high throughput innovation in the pipeline. So to put the data, the unicorn data into context, it's helpful to briefly review the broader market environment in the second half of 2025. Crypto markets entered the fourth quarter with positive momentum, supported by strong Bitcoin performance, sustained spot ETF inflows, and increasing institutional participation. Now, granted, we did see a little bit of volatility through Q4, but general sentiment held strong to allow a good system of support for growth going forward. At the same time, the markets have remained highly selective. Liquidity and incremental capital flows were concentrated in a relatively small set of large, highly liquid networks, while many smaller assets continued to lag. So what we're seeing with that is that we're seeing dispersion rather than broad-based appreciation. And that really puts into context the importance of liquidity and regulatory clarity here. One of the defining features of the second half of 2025 was also the continued institutionalization that we're seeing in the digital asset ecosystem. Spot Bitcoin ETFs remained a dominant driver of market structure, and they anchored liquidity and served as a primary regulated on-ramp for institutional capital. Beyond ETFs, Bitcoin on the balance sheet and as a treasury asset, that continued to expand, further reinforcing its role as one of the core beneficiaries of institutional flows. If we look at capital markets more broadly as well, activity increasingly focused on infrastructure, data providers, and custody. These are specifically areas that benefit directly from regulatory progress and enterprise adoption. So using that institutional lens is critical to understanding why value creation has still persisted even as speculative activity declined. So as at the end of 2025, there are 113 private blockchain enterprise unicorns and 67 crypto projects trading above $1 billion. Fifth era, we have exposure to 64 of the enterprise unicorns and 21 of the token unicorns. So private enterprises valuations continue to rise, which is supported by adoption and improving exit visibility. And clearly, what we're seeing is public market access is now the dominant theme heading into 2026. On this slide here, we can see the unicorns that Fifth Era is invested in, which is more than 80 blockchain unicorns across different stages and across different geographies. This represents exposure to nearly half of all early stage blockchain ventures that have achieved this billion-dollar scale. So the objective here is not concentration in single outcomes, but consistent access to category leaders over time. So going into the nitty-gritty here with the blockchain enterprise unicorns, I'm going to cover these next few slides together as they're all part of the same data set and tell a single story when you look at them as a whole. So as of year-end 2025, as I mentioned, there are 113 private blockchain enterprise unicorns globally, which spanning across 17 countries represents more than $380 billion in cumulative value. So what's important to emphasize here is not any single company, but the breadth and composition of this list. Not so surprisingly, some of the largest names at the top are exchanges and trading platforms like Binance, Coinbase, Kraken, etc. And they continue to dominate given their scale, their liquidity, and the role that they play in the ecosystem being so central. But I would say that this list is very far from monolithic if you look into it. It also includes infrastructure providers such as Alchemy, Starkware, for example, custody and crypto banking platforms as well, like Corpa and Signum, and enterprise-facing solutions which span across tax, compliance, payments, settlements. So the list is quite diverse, and we're seeing a lot of activity across these verticals. So that reinforces a point that we've made consistently over the years. Blockchain value creation, it's not confined to a single narrative or a vertical. It's distributed across a full stack of digital finance and commerce. So as we move through these slides, you'll also notice the markers indicating fifth era exposure. We're invested in a significant portion of these companies, reflecting long-term access to these category leaders rather than short-term positioning. From a dynamics perspective, what has changed since mid-year is not the emergence of entirely new categories, but the rotation within this group. We continue to see new companies crossing the billion-dollar threshold, even as some others exit through acquisitions, spin-outs, public listings. For example, we saw a bullish figure in Gemini IPO in the second half of last year, and that churn is exactly what keeps the headline count stable while value continues to be realized. So rather than looking at these slides as static lists, I think it's more helpful to think of them as a snapshot of a living pipeline, one where companies are constantly moving towards liquidity at the top end while new entrants continue to scale underneath. This chart here shows exactly that. The total number of enterprise blockchain unicorns has remained relatively stable over the past few quarters. And this pattern actually mirrors what we observed in the SaaS and fintech spaces when once those markets matured. So capital is increasingly flowing towards proven platforms, even as new companies continue to emerge and reach meaningful scale. Now, this slide also highlights something we've been pointing out consistently over the course of these reports we've released. Blockchain fintechs continue to dominate the enterprise unicorn landscape. And in particular, we see the bulk of the value creation in that middle layer, what you might call the transactional layer of the technology stack. So that includes payments, trading, settlement, custody, etc., that enables financial activity to move on chain in a compliant and a scalable way. That aligns very closely with our thesis as well. At its core, what the technology, blockchain technology is doing is enabling the digitization of finance and commerce. So it's not surprising that the largest, most durable companies that are emerging in this ecosystem are the ones that are directly involved in moving value, managing assets, facilitating transactions as well. And this has not been true just for this year or this quarter, but in prior editions of this report as well. The persistence of this reinforces the idea that blockchain adoption is being driven by real economic activity and not just speculative use cases. As the industry continues to mature and integrate more deeply with our traditional financial systems, we expect this part of the stack to continue capturing share of enterprise value. Moving on to the blockchain token unicorns. Again, I'll cover these two slides together as they're telling a single story about how token markets have behaved. At year-end 25, there are 67 tokens trading above $1 billion. That is meaningfully lower than this time last year. And at first glance, that looks like a sharp contraction. But the drivers here are very important to understand. The primary dynamic has been the concentration of capital right at the top of the market. Throughout 2025, liquidity, ETF inflows, and just the general attention from institutions remained heavily focused on a very small group of major assets. These are primarily Bitcoin, Ethereum, and increasingly Solana. These assets benefited from direct institutional access via ETFs, and they've been part of treasury strategies, and regulatory clarity has improved around them. But in contrast, for most altcoins, they remain largely excluded from those same channels. That leaves them dependent on a much thinner pool of risk capital. At the same time, these altcoins have also faced structural headwinds. These are the likes of token unlocks or emission schedules, legacy vesting overhangs. That creates persistent sell pressure, and it often overwhelms organic demand, even when projects continue to ship product and grow usage. So, macro conditions, of course, have played a part. Interest rates being higher for longer, that's reduced appetite for long duration and high volatility assets. So investors became a bit more selective about where they deployed their incremental capital. So what that means is we see a sort of bifurcation here. Majors hold up relatively well, but much of the long tail of tokens they reprice downwards. So that explains why the number of billion-dollar token projects declined, even though the underlying development activity and progress in the infrastructure in the ecosystem, that's continued. So this dynamic is, we best view it perhaps as cyclical rather than structural. So history suggests that institutional adoption typically starts at the top of the risk curve before rotating downward. And we're already seeing some early signs of that progression, with attention expanding first from Bitcoin to Ethereum to Solana, and now towards multi-asset products and treasury strategies. So rather than signaling a breakdown in token-based value creation, these slides reflect a period of consolidation and digestion, one that's laying the groundwork for a more regulated next phase. So we've just spoken about the volatility in token prices, but despite that, the underlying indicators of market activity here, they continue to trend positively through 2025. Exchange volumes remained resilient, stablecoin supply continues to grow. That reflects their increasing use more as core financial infrastructure rather than just purely trading instruments. These trends suggest that while risk appetite has fluctuated, the underlying usage and settlement activity that's continued to expand. So this distinction again between surface level price action and deeper, more the structural adoption is an important theme as we continue thinking about long-term value creation. So stepping into the public side of things with the public blockchain companies and the exit environment. So public markets, they've played a increasingly more important role in shaping outcomes during the second half of the year. There are now 31 public blockchain companies with a cumulative enterprise value exceeding $188 billion. I would say the distribution is slightly barbelled here, with a few very large leaders and a relatively long tail of smaller scale companies. More importantly, we're seeing renewed public market receptivity for mature digital asset platforms. Multiple infrastructure and exchange businesses advanced confidential IPO filings in late 2025, signaling that public equities are once again a viable exit channel for scaled regulated businesses. So that improves liquidity prospects for late stage private investors and reinforces public markets as a pretty important part of the blockchain exit landscape. Another key driver here for an institutional engagement was the developments on the regulatory side of things. In the United States, momentum continued to build around market structure and stablecoin legislation. That improves long-term visibility, even as near-term implementation timelines are not quite set in stone. Agency level guidance that includes work on token classification, custody frameworks, that's increased a bit of predictability for issuers, custodians, and intermediaries as well. With something similar in Europe with the MiCA regime, which has continued its transition towards full implementation that reinforces expectations around licensing, capital adequacy, operational resilience, and generally builds a bit more optimism in the market. So collectively, these developments are anchoring institutional allocation decisions and product development across the sector. Looking at Bitcoin ETFs now, globally, there are more than 30 spot Bitcoin ETFs. These products have anchored institutional demand and improved liquidity and allowed for public market participation with a little bit less friction. So, in periods of volatile price action, institutional holdings like these have kind of helped anchor, relatively speaking, considering the asset class we're discussing. ETFs have played a central role in integrating crypto into traditional capital markets. To close out the market structure discussion here, I want to spend a few moments on what has kind of emerged as a new but not so new public market dynamic over the past year. So, in addition to public blockchain companies and ETFs, we're now seeing a growing group of public companies adopting Bitcoin as part of their treasury strategy, a model pioneered by Strategy, previously MicroStrategy, and increasingly now replicated by others. As of year end 2025, there's over 100 public companies holding more than $10 million of Bitcoin. This in total represents more than $160 billion in cumulative market cap. So, what's important to understand here is why investors view these vehicles differently from ETFs or direct Bitcoin ownership. When you buy Bitcoin directly or through an ETF, for example, exposure remains static. You own a fixed amount of Bitcoin and that exposure doesn't grow over time. A corporate treasury vehicle, on the other hand, has the ability to raise capital, deploy it opportunistically, and increase Bitcoin per share over time. So that optionality, when it's executed well, is what's allowed companies like Strategy to trade at a premium to the net asset value of the Bitcoin that they hold. Of course, this strategy is not entirely free of risk. It's very, very dependent on management discipline, things like capital market access and timing as well. So not every company will be able to execute it successfully, but the rapid emergence of this category is what we focus on, which tells us it tells us about investor demand. So there's strong appetite for regulated equity-based vehicles that provide an almost dynamic exposure to Bitcoin within public markets. So as we move through these slides, what you're seeing is not a single anomaly, but the early formation of a new access layer, one that sits alongside ETFs and public blockchain equities as a third pillar of public market crypto exposure. This trend reinforces the broader theme we've discussed throughout today's presentation. Blockchain value creation, it's no longer confined to just private markets. It's increasingly being absorbed, structured, and at this point being scaled through public market vehicles. So this chart helps put the previous discussion into perspective by showing how rapidly Bitcoin Treasury adoption has accelerated over time. While there were a handful of early adopters several years ago, Strategy again, the curve steepens meaningfully over the past year. That inflection coincides with a few sorry, that inflection it coincides with a few important developments that we've already gone over a little bit today, and that's improving regulatory clarity and growing comfort amongst management teams which hold Bitcoin as a strategic asset. It's also worth noting that this growth has not been driven by just speculative companies alone. Increasingly, these are operating businesses making deliberate balance sheet decisions and viewing Bitcoin as a long-term store of value rather than a short-term trade. This acceleration, it reinforces the idea that Bitcoin is moving away from the periphery of capital markets and into the core of corporate financial strategy in a more traditional sense. Now, stepping back a little bit to summarize everything we've covered today, the core message is consistent with what we highlighted right at the outset. The blockchain industry continues to mature structurally, even with volatility at the surface level. Enterprise unicorn counts have remained broadly flat, but that stability reflects a healthy balance between the companies which exit via acquisitions or public listings, as well as still new companies being created, continuing to reach unicorn scale. At the same time, value creation is also spilling into public markets through public blockchain companies, ETFs, and corporate treasury strategies, expanding both exit pathways as well as access points. So, token markets as well have gone through a period of consolidation and digestion, driven by concentration of capital at the top of the market. The structural headwinds across the long tail is something we've seen. It's not a breakdown in underlying development or adoption per se. So, altogether, these dynamics reinforce our long-standing thesis. Blockchain is transitioning from a disruptive technology into foundational financial infrastructure, and value creation is becoming more durable, institutional, and globally integrated. Thank you very much for everyone who's joined today. If you'd like to go any deeper into the methodology, portfolio exposure, or any of our specific funds, please reach out to ir@fifthera.com, and we're happy to continue the conversation. Thank you.